US dollar just hit 16,000 rupiah per US dollar in the early April 2024. This phenomena is very related to international finance. So today we're going to talk about international finance. Hello, my name is Alphin Immanuel. I'm from IPMI International Business School and I'm currently attending international finance class. So today I'm going to share with you what I've learned so far until week 7 through this mind map presentation. So start with these quotes that we've learned, we've seen so far, every meeting from Prof. Roy. It's from Confucius that said, if your plan is for 1 year, plant rice. If your plan is for 10 years, plant trees. If your plan is for 100 years, educate children. Oh my God. Okay, so what have we learned so far? We've learned about 6 topics. The first is review of corporate finance, which is the review from before semester, global economy and international finance, and then we learn about foreign exchange rate. We also learn about international arbitrage and parity framework. We learn about foreign exchange risk, not only rate, but also the risk. And we also learn about foreign exchange forecasting. So first, we're going to talk about the review of corporate finance. Corporate finance is consists of goal of firm and principal agent problem. It's also we learn about the 4 corners of the corporate finance and the principal agent problem that we've seen so many times. The time value of money is very useful for us to determine if whether the value of our money is still in the consistent, is still in the reliable value, unreliable value. And we learn about the net present value in that time value of money. Value creation, we talk about assets because assets is the value creator. Assets is considered into 2 different assets, which is tangible asset and intangible assets. Risk and rate of return. We learn about capital asset pricing model or CAPM. Capital budgeting methods. We learn about 2 methods. The first is payback period. The second is net present value or NPV, profitability index or PI, and in index of rate of return or ERR. The next topic is global economy and international finance. We learn about history of global economy, which is based on the history money is flowing anywhere. It's maybe from the Roman until today to many money just flowing to the China. We learn about multinational corporation that if you are doing your corporation into multinational corporation level, it costs you very much and it benefits you very much. As we see on the table on the below, I would say below, is in this presentation, is an investment opportunities of the MNC is more broader than the purely domestic firm. It's also about the financing opportunities, as the financing opportunities on the MNC is more broader, is more bigger than financing opportunities if you are a purely domestic firm. It means that the asset of your firm, it can be more broader because the investment that you have is more broader from many different banks around the world, and financing opportunities of your firm is also bigger because it's coming from around the world. That makes the marginal return on the projects is more bigger, and also the marginal cost of capital is more bigger. That means that the size of your firm is more bigger when you're becoming multinational corporation. Next is foreign exchange rate. Foreign exchange rate is the rate of your foreign exchange to exchange your currency into the foreign exchange. If you're traveling, you need to change your currency to the local currency that your destination to go. In that things we call it foreign exchange market. Foreign exchange transaction is the one that you do if you're changing your currency. It can be used spot market trade, forward market or interbank market. And the currency market is about the future contracts and call option. It's more like the firm size of the contracts and options. And there was a factors that affect currency rates, exchange rates. Because the fluctuation, as I've said before, like 16,000 now. I don't know what 2 years more or 5 years more. It can be more. It can be lower than 16,000. We never know. So the first thing is the demand and supply of the foreign currency and domestic currency. That one that always been changing because of the currency exchange rate. This happened because the demand and supply of the goods or services for the foreign domestic and of course and there is perception and the demand and supply of the securities about the foreign and the domestic securities. So the first, what uh, causing the demand and supply of goods and services, foreign and domestics? First is relative inflation rates, second is relative income, and third is government restriction on flow of goods and services. Those three things is affecting the demand and supply of goods and services, foreign and domestic. And next is the things that affecting the demand and supply of securities of the foreign and domestics. Relative interest rates and government restriction on capital flow is the one that affecting, really much affecting what demand and supply, securities, foreign and domestic. And the last thing is risk perception that we do. It's more about physiological things into the investors to do, into perceive. And this is just a simple figure that we can learn about this. It's more complex than this, but the things that we learn from this, I think what they understand from this that this is the everyday business operation if you are in the multinational corporation. Next is international arbitrage. The international arbitrage, we differentiate the arbitrage into three arbitrage: locational arbitrage, triangular arbitrage, and corporate interest arbitrage. Arbitrage is also affecting by the three formulas, by the three theory that we learn. The first is purchasing power parity or PPP. The second is interest rate parity. The third is international Fisher effect parity. For more clearer, we can see this figure. As we can see, the forward trade premium, forward trade discount or premium are affected by interest rate differential through the theory that called interest rate parity. Inflation rate differential is also uh, affected by the Fisher effect, and it's also affecting the exchange rate expectation in the terms of purchasing power parity or PPP. That also is changing. It's also affecting the international interest rate differential through the theory that named international Fisher effect, because the exchange rate the expectation, because the higher expectation of exchange rates, it will be affecting the higher interest rate differential and it will be higher inflation rate differential. Next is the foreign exchange risk. We divide into three exposure or risk. The first is transaction exposure. There will be 6 methods that you can use, that you can learn to mitigate, to lowering the transaction exposure or transaction risk. The first is for forward contract. The second is future contract, money market hedge, forex swaps, currency swaps, and currency options. The second exposure is translation exposure, and the third is economic exposure. The last thing is foreign exchange forecasting. The first technique that we can use to forecasting the foreign exchange is technical forecasting, which is using the historical data. As the people say, history repeats itself. The second is fundamental forecasting that we use the economic variables such as, you name it, inflation rates, national reserve, and etc. Market-based forecasting is about market indicators. Like if you're in the market, maybe you can use the EISK in the If you're in Indonesia, you can use IDX composite. And the last thing is a mixed forecasting, which is the combination of many techniques. You can use two of them, you can use three of them. You can use technical and fundamental forecasting, can mix all the way up until you have the better forecasting maybe, or the suitable forecasting for you. So overall, that's all from me. That's all that I can share to you. Thank you so much for listening and hope you have a good day. Thank you so much.